Hello everyone and welcome to another analysis video. Today we'll go over Microsoft Corporation stock, but before we start that I want to mention three things. First, this is not a financial advice and it is for entertainment purposes only. Second, please consider supporting this channel by subscribing and liking this video. It means a lot for me and it's just 2 clicks for you because it motivates me to make more videos. And let me know in the comment section what do you think about this analysis, or if there is a specific stock that you want me to analyze. The last thing I want to mention is that this video is going to have 2 parts. First, we're going to go over the last annual report filed with the SEC, and then we're going to go over the financial statement analysis. I'll put in the description box the time where the financial statements analysis starts if you want to jump to it immediately. You are looking at the last annual reports that the company filed with the SEC for the fiscal year June 30, 2022. And this report contains the financial statements for year 2022. I know it's confusing because the calendar year did not finish yet, but their fiscal year ends on June 30th, so these are the financial statements for 2022. If you wonder where did I get this report from, I got it from the SEC website. So if you go to sec.gov, click on company filings, and then put the ticker symbol or the trading symbol, and click over here, you'll open Microsoft page. And you can view all the different reports the company have to file with the SEC. From here you can find the annual reports and the quarterly reports, and those are the most recent reports filed with the SEC. And if you click here, change the date, you'll find all the previous quarterly and annual reports. On the first page we can see that there is only one registered equity security, which is the common stock, under the trading symbol MSFT. There are 2 trading notes, but we are concerned about the stock for this video. And if you scroll down, you can see the outstanding shares at the end of the fiscal year, and it's about 7.4 billion shares. We'll go over the change of outstanding shares at the financial statements analysis. Reading the annual report provides a good background about the company's operation, and here they are saying they divided the revenue streams from 3 different segments. First one is productivity and business processes, second intelligent cloud, and third, more personal computing. Under each segment, there are a number of items that I have listed that generates revenue. For example, productivity and business process, they have the Office Commercial and Office Consumer, LinkedIn, and Dynamic Business Solutions. I think everyone know and have used at some point the Microsoft Office software, like for example, Microsoft Word, Microsoft Excel that I'm using in this analysis. LinkedIn is a social media for professionals. You can find many professionals registered there and many companies, and it's a great way and easy way for recruiting. Dynamics Business Solutions is a software geared toward companies as a planning resource and customer relationship management. Their second segment is Intelligent Clouds and includes service products and cloud services and enterprise services. And the third segment, that is more personal computing, include Windows, that's the operating system for all the PCs, and revenue from devices like the Surface and the PC accessories, revenue from gaming like the Xbox, and revenue from search and news advertising. And this part they are showing us the increase in revenue across all different items of their operating segment. And as we can see, all of them have increased in 2022 comparing to 2021. And to put it in numbers, they have the results for each segment operation, and as we can see, overall change have been 18%. It ranged from 10 to 25%, but overall change for 2022 is 18%. And their operating income also have changed and increased by 19% from last year, even though their revenue increased only 18%, which tell us they are also being smarter with their expenses. And in this part of the report, they are showing us the shares repurchased only on the 4th quarter, which is about 28 million shares. And in the analysis section, we will go over the change of outstanding shares. Also, they are stating in the 4th quarter of the fiscal year 2022, they distributed 62 cents in dividends. Something I encourage everyone to check when reading an annual report is to check the report of independent registered public accounting firm, which in other words, the accounting firm that audited the financial statements. And we want to look at this highlighted standard paragraph when there are no issues in the financial statements. And basically they are saying the financial statements presents fairly in all material respect the financial position of the company for the mentioned years 2021 and 2022. And basically this means The auditors didn't find anything wrong with the financial statements, and they trust it, so we have to trust it as well. Now let's jump to the financial statements analysis. Over here I have gathered data from all three different financial statements, the income statement, balance sheet statement, and the statement of cash flow for the past 7 years, from 2016 to 2022. And as usual, I decided that the return on investment is 5%, and the discount rate should be the T-bill interest rate, which is 3.955. If you don't know where you get this information, if you go to treasurydirect.gov, that's the website, the official website where you can buy government debt securities, and click on Treasury Marketable Securities, you'll find 3 different types of government debt securities: bills, notes, and bonds. We are interested about bills because this analysis focuses only on 1 year, and the maximum life of the treasury bill is 1 year. So if you click and then click on results of recent bill auctions, and then click on 20 most recent auctions, scroll down until you find the latest 52-week auction. You will find the interest is 3.955. Moving to the next tab, we can see that the revenue have been growing every year for the past 6 years, and the past 2 years have been growing at 18%, which is amazing for a company this size to have a growth every year. The cost of revenue have been decreasing in the past few years, and it is very stable in the 30%. Operating costs have been decreasing for the past 6 years and is very stable. We don't see any jumps in the prior years. Times interest earned ratio is how many times the interest expense the company is making and earning. And this ratio helps us to understand if this company is going to be able to service their debt. And as we can see in 2022, the company have made 78 times more than the interest expense in earning. Outstanding shares have been decreasing every year for the past 6 years. Total decrease is 4.4%. And that's very good for the remaining shareholders because they will have higher earning per share and higher free cash flow per share. Moving to the balance sheet, their debt is also have been decreasing in the past 6 years. It's currently at about 14%, which is something very good, and it also might explain why they have high times interest earned ratio. The liabilities in the 50% and also have been decreasing, and 54% is not something to worry about. Looking at the cash flow statement, we can see that the operating cash flow is larger than the net income for every year in the past 6 years, and that's something we want to see. So down here I have one forecasting scenario this time, and it depends on 3 items: the forecasted revenue, the forecasted outstanding shares, and the forecasted free cash flow. To forecast the revenue, I use working capital to revenue ratio. The working capital is the difference between the current assets and the current liabilities and stands for the liquid that the company has to conduct their operations in the next year. And the working capital to revenue ratio basically is telling us how many dollars in revenue are generated from $1 of working capital. If we scroll up, we can see in 2022 it was $2.07. So basically every dollar in working capital would generate $2.07. And because it have been increasing for the past 6 years, I decided that this number should be at least 2.25, which gives us a revenue of $167 billion. Now if we stop here for a second and look back how much the revenue was in 2022, it was $198, but I'm forecasting it to be $167. I think the reason because this year they have a very low working capital, which is this $74 billion. Look at the working capital for all the prior years. Last year it was 95, the year before 109, and before that almost all the years above 100 billion. This year they only have 74 billion, which in my opinion is going to hurt Microsoft revenue. That's why next year revenue in 2023 I think is going to be 167 billion. I decided that the forecasted outstanding shares for the year 2023 will be 0.07 less than 2022 outstanding shares because that's the average of the last 2 years. And to forecast the free cash flow, I use the free cash flow to revenue ratio. And if we see here, almost stable in the 30%. It ranges from 30 to 33. So I use 32.9%. That will give us 55 billion forecasted free cash flow and $7.46 free cash flow per share. Discounting that using 3.955, which is the T-bill interest rate, that will give us $7.16. So if the required return on investment is 5%, then the most we have to pay for the Microsoft share is $143. Now, if you look at the Microsoft stock price chart for the past month, we can see that it's ranging from $249.20 to the lowest amount, about $225, which is way higher than our intrinsic valuation. I think it has two reasons. First, this company is a dividend company. Certain institutions like dividend companies, so they will pay more to invest in Microsoft Corporation. And as we can see here, last year's dividend was $2.43. Comparing it with prior years, it has been growing by at least 10% year over year. And the second reason, I think Microsoft has very low risk as a company. I don't think there is a serious competitor with Microsoft out there. Especially that Microsoft have diversified their revenue, as we saw earlier in the three operating segments. So this tells us the market is not requiring 5% return on investment from Microsoft stock. But if we change it to 3%, it will give us about 238. So I'm assuming then the market is requiring 3% return on investment from Microsoft because they are dividend stock and they're very stable and expected to last for another 50 years. So thinking from the perspective of a value investor, I think this stock is very overvalued because this stock is at least overvalued by $100 if we decide that the return on investment is 5%. But if it's okay for you to have a 3% return on investment, then it is not an overvalued stock for you. Thank you so much for watching this video to the end. Please consider liking this video and subscribing to this channel.